Hello all, welcome back to my channel. This is Stocky. Today let's see what is hedging. Hedging is a risk management strategy used in various financial markets to reduce or offset the potential risks associated with price fluctuations. It involves taking an offsetting position in a related asset or derivative to protect against losses from adverse price movements in another asset. The primary purpose of hedging is to minimize the impact of adverse price changes, thereby safeguarding investments and reducing uncertainty. For example, in the stock market, an investor might buy shares of a stock while simultaneously buying a put option on the same stock. If the stock's price falls, the put option provides the right to sell at a predetermined price, limiting potential losses. Hedging strategies can vary widely and are used in various financial contexts, including currency exchange, commodities trading, and investing in stocks or bonds. The goal is to manage and mitigate risk, ensuring financial stability and protecting investments in volatile markets. Hedging strategies are used to manage and mitigate risk in various financial markets. Here's a brief overview of some common hedging strategies. Forward contracts. These are agreements to buy or sell an asset at a predetermined price on a future date. They are often used to hedge against currency exchange rate fluctuations, interest rate changes, or commodity price movements. Options. Options provide the right, but not the obligation, to buy, call option, or sell, put option, an asset at a specified price within a specific time frame. They are frequently used to hedge stock or currency positions. Futures contracts. Similar to forward contracts, futures contracts obligate the buyer to purchase and the seller to sell an asset at a specific price and date. Futures are commonly used in commodities and index hedging. Put and call options. These are frequently used in stock hedging. Put options can protect against declining stock prices, while call options can hedge against rising prices. Swaps. Swaps are over-the-counter (OTC) agreements where two parties exchange cash flows. Interest rate swaps can hedge against interest rate fluctuations. Natural hedges. Some companies use natural hedges by matching their revenues and expenses in the same currency. For instance, a multinational company might try to match its sales in euros with its expenses in euros to avoid currency risk. Pairs trading. This strategy involves going long on one asset while simultaneously going short on a related asset. It aims to profit from the relative performance of the two assets while minimizing market risk. Cross-hedging. Cross-hedging involves using a derivative to hedge against a risk that is related but not identical to the underlying asset. For example, using oil futures to hedge against the price of jet fuel. Diversification. Diversifying a portfolio across various asset classes, such as stocks, bonds, and real estate, can reduce overall risk by spreading it across different investments. Dynamic hedging. This strategy involves continually adjusting a hedge position as market conditions change. It's often used by portfolio managers to protect against adverse price movements. The choice of hedging strategy depends on the specific risks a trader or investor wants to manage, the assets involved, and the market conditions. Each strategy has its advantages and disadvantages, and the effectiveness of a hedge depends on the accuracy of the prediction and the skill of the hedger. Practical implementation of hedging involves using various financial instruments or strategies to protect against potential losses in an investment or portfolio. Here are some steps to implement hedging effectively. Identify the risk. Begin by identifying the specific risk you want to hedge against. It could be currency risk, interest rate risk, market risk, or any other risk associated with your investments. Choose the appropriate hedge, select the right hedging instrument or strategy based on the identified risk. For example, if you want to hedge against currency risk, you can use currency forwards, options, or futures. Determine the hedge ratio. Decide how much of your portfolio or investment you want to hedge. This is known as the hedge ratio. It's important to strike a balance between protecting against risk and allowing for potential gains. Execute the hedge. Once you've chosen the instrument and determined the hedge ratio, execute the hedge. This might involve buying put options, entering into futures contracts, or using other derivatives. Monitor and adjust. Continuously monitor the performance of your hedge. If market conditions change, be prepared to adjust your hedge accordingly. For example, if you're hedging against falling stock prices and your stocks start to rise, you may need to modify or remove your hedge. Cost-benefit analysis. Consider the costs associated with your hedge. Hedging can be expensive, so weigh the potential protection against the costs. Make sure the cost of the hedge doesn't outweigh the potential losses. Diversification. Diversify your portfolio. While not a hedging strategy per se, diversification can help spread risk across different assets and reduce the need for extensive hedging. Risk assessment. Regularly assess your overall risk exposure. As market conditions evolve, so does your risk. Periodically review your portfolio and adjust your hedging strategy as needed. Stay informed. Keep yourself informed about market conditions, economic indicators, and geopolitical events that might impact your investments. Being aware of potential risks will allow you to make timely hedging decisions. Professional guidance. If you're new to hedging, consider seeking advice from financial professionals or using the services of a financial advisor. They can provide valuable insights and help you create a suitable hedging strategy. Remember that no hedging strategy is foolproof, and there are always inherent risks. Additionally, the effectiveness of your hedge depends on your understanding of the market and the accuracy of your predictions. Properly executed, hedging can provide protection and stability in your investment portfolio. So, this was the complete basic idea about hedging. Let me know in the comment section, which topic would you like to know about next? Do like, share, and subscribe. Till then, keep learning.